So, good morning. I want us to continue with cash flow, statement of cash flow. That is 7. This one will be our final class, and we shall focus on this question. The question is for November 2018. Question number 3, boy. November 2018. Question number 3, boy. So make sure you have the past paper because I'm not going to present. I'm going to read it. So the financial statement of Sasumua Sasumua Ltd and its investment company for the year ended 30 September 2018. So we have the consolidated statement of comprehensive income for the year ended 30th September 2018. So we have the information there. Then you have the consolidated statement of the financial position as at 30th September. Also, we have the assets. We have for the year 2017 and 2018, the information for assets, current assets, total equity, current liabilities and non-current liabilities has been provided. We have also been provided with the statement of changes in equity for the year ended 30th September 2018. That is for ordinary share capital, share premium, revaluation, retained earnings, and the totals. Additional information. So we shall focus in additional information kama kawaida. So as usual, we shall focus with the additional information before we formulate the consolidated statement. So information number 1 is about PPE. Additional information number 1 is about PPE, and that is a must because for PPE we need to determine if we have a gain or disposal. So let us prepare the PPE account. PPE account, property, plant and equipment. Property, plant and equipment. So we start with the PPE account, and in this case now the PPE will be on cost because we have been provided with the information about cost. So that's our T account. So the information about cost, information number 1, property, plant and equipment comprise of the following. So we have the cost, accumulated depreciation, and the carrying amount. Those items have been provided for the year 2017 and for the year 2018 as at 30th September. So the balance at the beginning is 2970. Remember, PP, the balance at the beginning is on the debit side. Balance brought down. So remember, this one is on cost, not on net book value. This one is 2970. Then you have balance carried down. Now our balance carried down is 3765. 3765. Then you need to put disposal at cost because we are talking about cost. Now let us see, was there any disposal during the year? Now during the year ended 30th April, 80% of an owned property of an owned subsidiary revalued their PP upward by 150 million. So we have a revaluation of 150. We shall put full amount for revaluation, even if there was a subsidiary where the company owned 80%. So for PPE account, revaluation is always put in full amount for PPE account. Revaluation. So for PPE, you always put the full amount. The holding company disposed an item of PPE at a cost of 290. So the disposal cost at a cost of 290. Now there is no any other account which affects this account. Depreciation for the year will not affect this account. Depreciation for the year will only affect the PPE or net book value. So when the PPE is on net book value, it is when we put the depreciation for the year. But in this case, that one will be it. I don't think there is any other account which affects. So let us balance it. So 290 plus 3765. This is 4055. 4055. So 4055. Then we find the balancing figure. 935. Now this one is the acquisition of PPE. Acquisition of PPE. So 935, that is the balancing figure. Acquisition of PPE. That's information number one, not yet completed. We need to determine the depreciation for the year because we have not been provided. So depreciation for the year. So we prepare accumulated depreciation account. Accumulated depreciation account. Now, so remember in our previous question that we have been doing, we were provided with the depreciation for the year. Now in this case, there was no any depreciation provided, so we need to compute them. So how do we compute it? We compute using the accumulated depreciation. So we compute the depreciation for the year by opening an account which is called the accumulated depreciation. So accumulated depreciation, the balance is on the debit side. Balance brought down. So the balance brought down at the beginning is 625. 625 and balance carried down, balance at the end. That's the additional information number one still. 934. 934. Now we balance this account. Now before we balance, we need to cater for accumulated depreciation for disposal. This amount that was disposed also had an accumulated depreciation which must be catered for. So the accumulated depreciation for the item, information number one, the holding company disposed an item of PPE at a cost of 290, which had an accumulated depreciation of 96. Now, when we balance this account, the balancing figure will be the depreciation for the year. So let's balance it. 934 plus 96. This is 1030. 1030. So meaning the balancing figure is 405. So depreciation is 405. So depreciation for the year is 425. So that is information number one. We have completed information number one. We can go to information number two. 10% convertible loan was converted at the 10% convertible loan stock was converted at any time at the holder's option into 20 ordinary share of 20 each for every 200. During the year, that is September, the holder of 180 million of 10% convertible bond was exercised. Now, so only 180 was converted. So only 180 million was converted. Only 180 million was converted. So let us try to do working here for the 10% loan note. So we can start with the balance. So we have the ordinary share capital and we have the loan note. Now let's start with the balance brought down. So the balance brought down for the balance at the beginning for ordinary share capital. If we go and check, it was 1,000. Then the balance at the beginning for the other one is 960. Then we had a conversion, but they said that only 180 was converted. So only 180 loan note was converted. So only 180 was converted. 180 million. Where is it? Nimepotea kidogo. Just a moment. So let us confirm how much will be the amount that will. So 180 was converted into into ordinary share capital. So 180 will be utilized from the loan account. So it will reduce the loan account by 180. But let's see the amount that will come to ordinary share capital. So for every 20, so when they convert 200 loan stock, they get 20 shares. They get 20 shares. Now, what about 180 million? What about 180 million? So let us put it in thousand because our question is in 1,000. Oh, sorry, our question is in million. So our question it is in million. So let us put it as 180 million. So how much will that be? So we can multiply. So 180 times 20 over 200. So how many shares? So how many shares? The shares will be equal to 180 times 20 divided by 200. That will be equal to 18 million shares. Now, but remember, one share is 20 shillings. So the power value, it is 10 shillings, sorry, 10 shillings. So how much will go as ordinary share capital? So it is 18 times 10, which is Kenya shillings, 180. Now we have confirmed. So that will be the amount that will come here. So we deduct 180 million loan stock, but we convert this loan stock to ordinary share capital. So when you convert this 180, still it's bring us to 180 million. That one. Then we deduct. Let us deduct and see. So 960 minus 180, that's around 780. And the other one, 1000 minus 180, that is 820. So not deduct, we are supposed to add. The other one we are supposed to add because it is coming in. So 1180. Then let us see the balance at the end. Balance carried down. So the balance carried down, according to the question, they are saying the balance for ordinary share capital is supposed to be 1320. And the balance for the loan stock, they are saying supposed to be 780. So we need to determine if we have an increase or a decrease or no. So for ordinary share capital, we have an increase from 1180 to 13. So that increase is an issue. When you have an increase, it's an issue of share. So there was an issue of share of how much? So 13, let us see the increase. 1320 minus 1180. You have an issue of 140. The other one, we don't have an increase, so it is 0. So for loan stock, there was no any issue. The only thing that occurred was the conversion. And the conversion, remember, does not have any impact in terms of money because it is within the organization. So there is no money in or money out. That one is okay. So once we are done with information number 2, we can go to information number 3. There is an impairment loss on goodwill that is charged in the P&L for the year. So let us see the impairment. So we go back to our non-current assets. We go to the goodwill account. So goodwill account. Because it's an asset, the balance will be on the debit side because it's an asset. So the balance at the beginning is 455. Then you have the balance carried down. The balance at the end is 432. 432. Then you can balance the account. There is no any other thing affecting this account because we don't have any other item. So 455 is the total. So we can get the impairment. So 455 minus 432, that is 23. So that is 23. So the items in black, they are the balancing figure. The item in black, they are the balancing figure. Now, once we have done with that one, we can look for other accounts that are important. Let's go to our balance sheet. So when you go to our balance sheet, we can see we have PPE is the first item we have done. We are done with it. Number two, we have the interest in joint venture. Now, for interest in joint ventures, because we have the interest in that company, then it means that there is dividends that we receive from that company. So we shall open a joint venture account. We shall open a joint venture account. Joint venture account. So this is a company where the company holds some shares between 19%, between 20% to 49%. So the company hold shares in this company between 20% to 49. Okay, not between 50%. So the company holds 50% of the shares in this company, and therefore the company has some significant effect in this company, but they cannot control this company. But they have just some significant effect in that company. So let us open this account. We see how much in terms of dividend that this the parent company receive. So because it's an asset, balance brought down since it's an asset. So the joint venture interest at the beginning is 380. Then you have balance carried down. Balance carried down for joint venture is 427. 427. So we need to balance this account. But before we balance this account, let us see if there is any item which affect this account. And in most cases is the profit attributable to the parent from the joint venture. So let's go to our income statement. We look for the profit or the share of profit of the joint venture. Sorry, supposed to be the profit share of the joint venture. So in our income statement, the profit, the share of profit of joint venture is 85. So profit share of the joint venture. So that's number two, profit. We say profit share of joint venture. It is 85. Now we can balance this account. So the balancing figure will be the dividend received. So the 80 plus 85. So that is 465. So dividend received minus 427. That is 38. So that will be 38. That one is the balancing figure. Dividend received. Let us see if we have any other item. So once we are done with the non-current assets, we can go to current assets. So current assets is not important to us because that one is for the working capital. The last one is the cash and the cash equivalent. Now equity. So we have done for equity, and that one is okay. Share premium, we have an increase by 60. That's an issue. So from 400 to 460 for share premium. At the beginning was 400, at the end is 60. At the beginning was 400, at the end is 460, meaning we have an increase. That increase is an issue of 60. Remember that 60, we shall add it with 140 to get 200 as a total issue. That one is okay for now. The valuation surplus, that one we have been so this one we shall not use it because we already have a revaluation in information number one. We go with the information number one. Even if there is a revaluation there of 84, we go with the information number one. Now we what about retained profit? Retained profit, we have the retained profit at the beginning and at the end. We need to determine if we have a if there was any dividend paid. So let us open the retained earning account. Retained earning account. So balance breakdown, because it is part of liability. The beginning balance is on the credit side, which is 360, and the balance carried down. The balance carried down is 570. Now then we need to put your profit after tax. Now, but because we have two profit after tax, we have the one from the income statement and the other one from the consolidated, the statement of change in equity. We have two types of profit. So the profit for the year is 315, and we have another profit in the statement of change in equity pale chini. Now we go with that one for the statement of change in equity of 290. You go with the one on the statement of change in equity. You go with the one in the statement of change in equity. So how much would that be? So 290 plus 360, that is 650. 650. Then dividend paid minus 570. 80. So we go with this one. So this profit, you go with the one in the statement of change in equity if you have been provided with the statement of change in equity. But if not, unaenda iko juu. And you can see clearly pale under the statement of change in equity, dividend paid is 80, which is the same amount. That one is fine. Which other account? I think let's go back to our equity and liability. So ordinary share capital, share premium, retained profit. Then you have the non-controlling interest account. That one is very, very important. We need to do our working. Also, that one is used to determine dividend paid. That one is used to determine dividend paid. So NCI. So what is NCI? Because it's the minority shares. The minority shares. This is the proportion of shares that is not held. So the proportion of shares that is not held by the parent company. That one is under group account. That is under group account. We shall review it on group account comprehensively. But for now, let us open the NCI account, the minority non-controlling interest account. So non-controlling. This one need to be just a moment. So non-controlling interest account. So the balance, because it's a liability, the balance is on the credit side, the balance at the beginning. So the non-controlling account, the balance at the beginning is 180. Then you have the balance carried down. The balance carried down is 186. Then we balance this account. But before we balance this account, let us look if there was any profit. Not profit, but let me check. We check if there is yes, profit attributable to the non-controlling interest. So because this one is a form of liability, the profit attributable to this account will be on the credit side. Unlike this one for joint venture, because it's an asset, the profit will be on the debit side. So in this one, the profit for NCI will be, so profit attributable to NCI will be on the, so let us say profit to NCI is 25. Then we need, because there was a revaluation, of 150, we need to put the share of the revaluation in this account. So the share. So remember, this company owns the subsidiary 80%, meaning 20% is not held. So that 20% we need to account for it under revaluation. So revaluation 20%. So remember, this company owns 80%. That is under information number one. Additional information number one. Information number one, they said during the year ended at 30th September 2018, 80% of owned subsidiary. So 80%. So the company owned the subsidiary 80%. So meaning 20% is not held, and that 20% is what we call the NCI. So they shall take on 50%. So 20% of that amount. So 0.2 times 150, that is 30. Now we can balance this account. The balancing figure will be equal to the dividend paid. Dividend paid. So let us see how much is it. So 180 plus 25 plus 30, 235. Then you less 186. So the dividend paid is 49. 49, that one is the balancing figure. So all the items in black, they are the balancing figure. Now I think the last account that is remaining, actually not the last account, we need to prepare the tax expense account. So tax account. So they are tax account. So balance brought down. So we can have deferred tax and current tax. Then balance brought down, balance carried down. So we have deferred tax and we have the current tax. So let us do that working. Hopefully the space will be enough. Yes, it will be enough. So don't worry about the space. Now let's go back to our statement, our balance sheet. So did you have deferred tax? Yes, we had deferred tax at the beginning, or it was 185. 185 at the end, it was 150. What about current tax? Current tax, we had 94 at the beginning, 92 at the end. 94 and 92, that one is okay. Now, but we had something to do with the income statement. So the profit in the income statement, not the profit, the tax. So income tax, that is the income tax. You can refer to the P&L because of space, P&L, but remember it's the tax in the income statement. No, income statement. We had a tax of 80 what? Tax of 80. Then remember, there was other just within the income statement and the other comprehensive income. They said that the revaluation gain on PPE had a net deferred tax. So they had deducted a net deferred tax. So meaning that tax will also affect this tax expense here under revaluation. Now, when you check the revaluation gain on other comprehensive income is 105. Remember, it's supposed to be 150. But in the other comprehensive income, they are saying that it is 105, meaning they have deducted the tax. Let's see the tax. Tax is 30%. So when you take 150 minus 30% times 150, you need to get that 105, meaning this is the deferred tax that has been deducted. That is the deferred tax that has been deducted. Now, we also need to capture the aspect of the group account. You also need to capture the aspect of the group account. Now, in this case, revaluation, which is the deferred. So revaluation we call it revaluation, but remember it is the deferred tax. It is 150, supposed to be 150, but remember you are supposed to tax it 30%. Then we give the share of the parent 80% because it's the parent. The parent control 80%, so the share of 80%. That will be equal to 150 times 0.3 times 0.8. That is 36. So then we balance this account. So those are the account. So remember, evaluation is affected by the share, either minority or the either minority or the group itself. But remember, PPE alone. Remember, PPE is never affected with the share. So you put the full amount. So for PPE 150, whether 80% or 20, you put the full amount, 100%. You assume as if the PPE is controlled 100%. But for the rest, for non-controlling, you need to non-controlling because the company holds 80%. Non-controlling means 20% is not held. So NCI is the minority. The minority is 20%. So you allocate the 20%. For tax account, because it's for the parent, you give the full amount, 80%, because it's the parent which controls the tax account. Now 185 plus 94 plus 80 plus 36, that is around 395. 395. Then dividend paid, minus 150 plus 92. That is equal to 153. And that one is the balancing figure in that case. Also, there is another account which is we need to prepare, the disposal account. Disposal account. Disposal account. This account usually do not have the balancing figure. So what we record is the cost. So the cost of an asset that was disposed, and you have it here. Disposal cost was 290. You can check it. Then we need to put the accumulated depreciation. So the accumulated depreciation for the disposal was 96. Now then we check if there was any gain on disposal. Now let's go to at the point where we information number one, the last statement. The holding company disposed an item at a cost of 290, which had an accumulated depreciation of 96. The proceed was 215. So we need to cater for proceeds. 215. So we balance this account. The balancing figure can either be a gain or a loss on disposal. So the balancing figure can either be a gain or a loss. So if it's a gain, you debit. If it's a loss, you credit. So let us see if it was a gain or it was a loss. So 215 plus 96, that is 311. 311. So meaning the balancing figure is a gain. Gain on disposal, so 311 minus 290, that is 21. And this is the balancing figure, 21. Then we have another final account that we need to prepare. That is the interest account. Now, remember in our previous question, when we were doing the consolidated statement of cash flow, the finance cost or the interest, we were taking it from the income statement direct. But in this case, we cannot take it from the income statement direct. Reason why? Because we have been given an interest payable account. Let's go to our balance sheet. If you go to our balance sheet, we have the interest payable account. Interest payable account. Interest payable account. Now, the balance at the beginning. So the balance, because it's a liability, the balance is on the credit side. So the balance at the beginning for the interest payable account is 31. And the balance carried down The balance carried down is 100. Then we go to our income statement. We check the finance cost. Now, if we go to our income statement, the finance cost is 85. The finance cost is 85. So we call it the P&L. Or you can call it finance cost. P&L is how much? How much? The finance cost 85. It is 85. Now remember, this is what I was explaining. Remember in our previous question that we have been doing, there was no any interest payable account. There was none. Because of that reason, because there was no any interest payable account, the P&L, the finance cost in the P&L of 85 will be taken to the adjustment of profit before tax as non-cash item of 85. If this account is not, if there is no any interest payable account or the balances in the balance sheet. Now, but in this case, in our question, we have the interest payable account, meaning the item the P&L is not the interest paid. It is not the interest paid. It is the interest, but not the interest paid. Now, for us to get the interest paid, then we need to, the balance sheet figure will become the interest paid. So let's balance this account to know the interest paid. So itakuwa ni 85 plus 31, that is 116. So this one is 16. So the interest paid is 16. That is all about the T accounts. There's nothing else about the T accounts. So what is remaining now is to formulate the consolidated statement of cash flow. So let us formulate the consolidated statement of cash flow. So the consolidated statement of cash flow. What is the name of this person? So this person is called this company is called let me go back. Sasumua Ltd. So we say Sasumua Ltd. Consolidated statement of cash flows for the year. The year is what? For the year ended 30th September. That is September. September and kweli. Yes. (2018). The amount is in million. So my pen, just a moment, I add ink to my pen. Now let us move on. So we say cash flow from operating activity, cash flows from operating activities We start with the profit before tax. Profit before tax. So we go to our statement, our income statement. Then we check for the profit before tax, which is 395. Number it is in million. Then you do an adjustment for So adjustment 4, we start with the first adjustment, the normal one. We can start with the depreciation for the year. Where is it? We prepared the accumulated depreciation account. So depreciation for the year is 405. So we start with that one. Depreciation for the year. So 405. So depreciation was added, was deducted, so we add it back. Depreciation was deducted, so we add it back. Then we had some impairment here, goodwill, impairment. Of goodwill. It was deducted, so we add it back. What else? We go back to our income statement. We see if there was any other income. Other income. Yes, gain on disposal of an asset. Gain on disposal of asset. So we go to the disposal account. The gain, we have it here, 21. So it was added, we deduct. So it was added, we have it here. So the gain on disposal, so it was added. So that one we deduct. Then we have the finance cost or the interest paid. Finance cost or the interest paid. Now we could have bring 85. The 85 which is in the P&L in our profit and loss account in our question, we could have bring 85. But because we have this interest payable account, we could not bring this one. So we need to find the balancing figure. So the balancing figure is 16, which is the interest paid. So it was deducted. We add it back. So it was deducted. We add it back. That is 16. Then share of joint venture. Share profit of joint venture. Share profit of joint venture. It was added, so in our income statement it was 85. So it was added, so we deduct. So it was added. Now we need to do what? To deduct. So it was added. So we need to deduct. Actually this one is supposed to be 85. This one. What was added is what we deduct. So this one, what was added. So what was deducted for this interest paid. Now I know we have this figure here. I will tell you where it will affect this account. Now, but in the P&L, what was deducted is what we add back. So what was added, what was deducted was 85. So what do we add back? The same 85. But for the interest paid, it will be on the other side. So what was paid during the year? So this is what was paid during the year. But this one is what was deducted, so we add it back as non-cash item. I think those are the account available. Now, once we have those accounts, let us get the final figure now. So 395 plus 405 plus 23 minus 21 plus 85 minus 85. So we are having a figure of 802. Then you do working capital changes. Working capital changes. So working capital changes, we check if there was increase or decrease in current assets and some payables account. So we have an increase in inventory. Increase in inventory. So inventory initially was 128 and now 170. So it was 128 and now 170. Then receivables also we have an increase. increase in receivables. So receivables was 240 now to 38. So 214 up to 238. Then payables, let us look for payables. Now for payables, it was that one, now 100. Sorry, not that one. It was 175. So increase in payables. So initially it was 175, now 234. So it was 175, now 234. It was 175, now 234. So that we can get now the gross cash flow from operating. So let us find the gross amount. So 170 minus 128, so it's 42. That's money out, because when inventory increases, it means you have bought more inventory. Same to the other one. So when an asset increases, then it means it is money out. Then the opposite is the same for liabilities. So this one you add. So 802 minus 42 minus 24 plus 59, that is 795. 795. Now, once with that one, we can less now tax paid, less tax paid. And in this case, our tax paid, it was 153. And also we less interest paid. Interest paid. Now, our interest paid now comes here. Now, if there was no this account, this amount of 85 will still feature here. This amount, 85, this interest of 85 will still feature here. But because we had the interest now payables account, the amount that will feature here will not be 85, but will be this 16. Now, once we have that one, we can now get net cash flow from operation. We can now get net cash flows from operating activities. And we call it A. We call it A. So how much would that be? 795 minus 153 minus 16. That is 6 what? 626. 626. Now, that is good. We can go to the next one. Cash flow from financing activities. Cash flow from finance or from investing activities. Cash flows from investing activities. I hope it is visible. Cash flow from investing activities. So we have number one, disposal. Proceed from disposal. Proceeds from disposal. From disposal. Now the disposal account, we have it here. The profit was 215. So we add it back. So that one is money in. Then you have dividend received from joint ventures. Dividend received from joint venture. Now our joint venture, we have it here. Dividend received is 38. That is money in. Then we have the acquisition of PPE. Acquisition of the PPE account. The PPE was 935. That is money out. Do we have any other acquisition? No. So you can get now net cash flow from investing activities, net cash flows from investing activities. So we got it to be, so 215 plus 38 minus 935. This one is minus 682. That one is okay, minus 6. So we can go to the last one, which is cash flow from financing activities, which will be our last part. Cash flows from financing activities. I hope this black pen is visible, because it is on a strike. It has refused to write. Anyway, we're gonna start with the issue of shares, because we did a working issue of shares. That is the ordinary share capital. Now the issue of shares, where was that working? So we had 140 share premium, issue of share premium. That one was direct because there was no any account which affect that one. So the share premium, it was 400, and at the end is 460, meaning we have an increase. So it was 400, now 460. So meaning the increase of 60, that's an issue. Apart from that one, so we had dividend paid now. Dividend paid to NCI. So where is our NCI account? We have it here, 49. Did we have any other dividend paid? Yes, we had another dividend paid, this one of 80. Dividend paid. We had 80. Did we have any other dividend paid? There was no any other dividend paid. I think that is all about it. Now we can get the net cash flow from our financing activities. Net cash flow from financing activities. So 140, we say net cash flow. Net cash flows from financing activities, and you call it C. So 140 plus 60 minus 49 minus 80, that is 71. Okay, so once we have that one, now we can get net cash flow, net cash and cash equivalent, net cash and cash equivalent. That is A plus B plus C. So add the 3, 626 minus 682 plus 71. That is 15. Is 15. Then we check on cash and cash equivalent at the beginning. So opening cash balance. I'm a bank balance. Opening cash and cash equivalent. So we had it here. So we had the 2. So how much was the opening cash and cash equivalent? We go to our current assets. So our current asset, the balance at the beginning is 63. So when you add this one, you need to get the balance at the end. So closing cash and cash equivalent. So that was supposed to be 78. I hope it is the same. So these 2 items, they are there in your balance sheet. So the 63, it is there in the balance sheet under the non-current assets. So when you take the net cash A plus B plus C, when you add the opening, must give you the end balance. I think that is all about this question. There is nothing more or less. There's nothing to add, actually. There is nothing to add. So that's how you are supposed to do that question of the consolidated statement, where you have the issue of joint venture and NCI, and also when your PPE is on cost. Uh, I guess that one will mark the end of statement of cash flow, but we shall do more questions as we progress it. But for now, consider with those questions that we have done. Then your assignment. Assignment. And in case you find any question which is challenging, find me. So we have a cash flow statement in August 2022. Question. That one I did it also. No, it was not bad. And then we also had this December 2025. 2025. I think this one was question number 5. This one I don't know which question is it. We shall check. December 2020. 2022. Then we had you can also try to do this one. It is a long time ago. December 2014. Question 5 had something to do with bonus. That one had to do with something called bonus. So thank you. Make sure you do more practice on questions. So let us meet. We meet for group account. So business combination. So we shall meet a little business combination. Other people call them the group account. Or the consolidated statements. So that will be our next topic. If you want to find me, that is my contact. So up to that point, let us meet tomorrow for the same topic, for the new topic.